Hi friends, welcome back to the channel. If you have been watching my past videos, you know I have shared my portfolio allocations. When I share this with my personal friends or friends in the Telegram group, one common half-joking response was that my portfolio looks like an ETF. That's actually quite true because I have 24 positions in my portfolio and 5 ETFs. Many would believe that this portfolio have too many holdings and over-diversified. Despite having so many positions, I have not owned a single SPAC in my portfolio. In this video, I will give my view on SPAC and why I have not invested into any SPAC. What is SPACs? SPAC stands for Special Purpose Acquisition Company, which is a Wall Street jargon for a publicly traded company that holds nothing but cash. Also known as blank check companies, SPAC exists to buy private companies and effectively take them public while avoiding the pitfalls of a traditional initial public offering. How do SPAC works? A SPAC's special purpose is to use the pile of cash it raises in its IPO and other funds it takes in to merge with a private company. The private company then gets the SPAC's place in the stock market. SPACs typically have 2 years to complete a deal or they must return money to investor. Lately, many have only needed a few months to announce mergers. Going public via SPAC is appealing because it lets private firms talk up their business. It also means their valuation is finalized with a small group of players behind closed doors before a deal is announced. In a traditional IPO, pricing can change until the night before shares start trading. Let's walk through an example. 1. SPAC sponsor form SPAC raises 200 million. This can take as little as 45 days but could be much longer, where the key bottleneck is sponsor ability to raise a few $100 million for a blank check. The convention is to price SPAC equity at $10 per share and the shares trade within a narrow band around $10 until an acquisition target is found. 2. SPAC sponsor searches for an acquisition target. SPAC agreement typically allow for a 24 months window to find and acquire a company. During this period, the SPAC is a public company with nearly blank financial statements. 3. SPAC identifies acquisitions target. The SPAC sponsor typically comes up with a list of target late-stage companies and engage each one to better understand their business and financing needs. 4. SPAC merges with acquisition target. The executions of the acquisitions takes 4 to 6 months, requiring due diligence, preliminary tender offer documents, and 8K filings. SPAC investor must then approve the transactions, which is the biggest risk in the de-SPAC process. If they reject the transactions, it means deal renegotiations or back to the search process. During the tail end of this process, the SPAC sponsor will coordinate a second group of investors who invest into the company alongside the SPAC via a private investment in public equity or PIPE. 5. PIPE investor invests 2 to 3 times SPAC size into company. PIPE investment typically accompany the de-SPAC transaction, which essentially add more equity leverage to the SPAC. SPAC sponsors coordinate the PIPE capital raise from hedge funds and PE firms who are tagging along for the ride. The ratio of PIPE to SPAC money is typically between 2 to 1 and 3 to 1. This means that a 400 million SPAC could effectively generate a total transaction size of 1.2 to 1.6 billion. There will be fees of around 20% of the size of the original SPAC, excluding the PIPE amount, which goes to the SPAC sponsor in the form of equity. This effectively means a blended fee of 5 to 6% for the company as a percentage of total capital raised, fairly similar to the 5 to 7% for a traditional IPO. SPAC fees are mostly equity-based to align the SPAC sponsor and the company, in contrast to the primarily cash-driven fees for IPO bankers. 6. SPAC and PIPE investor receive equity warrants. After the acquisitions, the SPAC sponsor looks like a large investor where they can take a board seat or 2. For more PE-style SPACs, this could involve active management and control by the SPAC sponsor. There are 2 main reasons I don't buy SPAC. Reason number 1 is what you pay is not what you get. Let's take Altimeter Growth Corp as an example. This is the SPAC that is going to merge with Grab. The SPAC raised $500 million in September 2020. You can see that there are $500 million cash held in trust account. The merger with Grab is yet to be completed. So if you own AGC shares right now, you are technically only own the blank check company or the shell company and not Grab business. The SPAC shares are traded on the stock market just like a stock, and the shares is determined by the supply versus demand. If the investor hype up on the stock, it is possible that the share price could go up. Here you can see that the total outstanding shares is 50 million multiplied by the $10 per unit, we get the 500 million capital raise. On the other hand, the market cap is determined by the price $11.76 multiplied by 50 millions, equal to around 588 millions. When the SPAC was hyped up, the price could shoot up. At its peak, AGC was traded at around $18, which means the market cap is at 900 millions. But this valuation figure will not change the amount of cash sitting on its balance sheet. If you are buying at $18, you are paying $18 to acquire $10 cash. This is almost like a 44% immediate loss. This is why I tend to say no to SPAC, especially if the share price is traded at a premium. Anyway, now Grab is traded at $11.6, so it is only 15% immediate loss. Second reason is that SPAC looks like a bubble right now. Take a look at the size of the capital raised by SPAC. The SPAC IPO started to ramp up in third quarter of 2020 and peaked in March 2021. As described earlier, after the IPO of SPAC, they will identify a target private company and negotiate a merger using the funds raised. The usual deadline is within 18 to 24 months of the IPO. Given that so much capital has been raised, the sponsor has pressure to close deal before the deadline. It makes sense to expect that the sponsor will offer a high valuations to private company to take them public. This means that highly likely SPAC will pay a disadvantaged price in order to close the deal. Good for the target company, but bad for the SPAC investors. Let's listen to Warren Buffett's comments with regards to SPAC.
This question comes from Sam Butler, who says he's been a shareholder for many years and asks, what impact does the rise of so many new SPACs have on Berkshire's ability to find and close new acquisitions?
Well, it's a killer. The SPACs generally have to spend their money in 2 years, as I understand it. So they have to buy a business in 2 years. If you put a gun to my head and said you got to buy a big business in 2 years, I'd buy one, but it wouldn't be much of one. We look and now there are, I don't know how many, whether it's hundreds, and there's always been the pressure from private equity funds. I mean, if you're running money for somebody else and you're getting paid a fee and you get the upside and you don't have the downside, you're going to buy something. And I could tell you about I had a call from a very famous figure many years ago that was involved in it, and I wanted to learn about reinsurance. And I said, well, I don't really think it's a very good business. And he said, yeah. He says, if I don't spend this money in 6 months, I've got to give it back to the investors. So it's a different equation that you have if you're working with other people's money, where you get the upside and you have to give it back to them if you don't do something. And frankly, we're not competitive with that. And that won't go on forever. But it's where the money is now, and Wall Street goes where the money is, and it does anything, basically that works. And SPACs have been working for a while, and you stick a famous name on it, you can sell almost anything. And it's an exaggerated version of what we've seen in kind of gambling done type market. In fact,
The amount of SPAC issuance has resulted huge amount of capital chasing for fixed number of private companies that have intention to go public. So it is about supply and demand, and likely SPAC investor will not be able to get a good deal. We can track the performance of SPAC throughout the rest of the year and next year to judge whether I'm right or wrong on this one. That's all I have for today. If you enjoyed the video, please remember to hit the subscribe button and like the video. If you are yet to open a Moomoo account, please consider signing up using my referral code. Link is in the description. You will get a free shares of Apple, and after that you can refer Moomoo to your friends. Each successful referral will earn you 1 Twitter share. Cheers and see you in the next one.